Good afternoon and welcome to Charting Points, a technical look at ag markets. Today is November the 3rd. I recognize that we were supposed to do this yesterday, but the day got carried away from me. And I find that it's probably more of an interesting discussion today anyway. I do have a special guest on the call here today, Miss Janelle Pickard. Are you there, Janelle?
Hello.
Did I pronounce your last name right?
Yeah, it's close enough.
Or is it Picard, like the with a French accent? Should I say it like Picard?
Yeah, I told my my husband he probably spelt it wrong, but weird. I was wrong and he was probably right.
Yeah. Well, thank you for joining. Thank you for joining us. I'll probably get accused of picking favorites, but I know this is kind of a last minute addition. I kind of threw you under the bus and asked you if you would be a part of this, just to kind of get your perspective and your family farms as well. So you'll have kind of a bit of a farmer perspective as well as an advisor perspective. So I really value that. All right, I'm gonna run through the disclaimer like we do every before we run into any of these. That's trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only and is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network or any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material. And any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future results. All right, now we're going to get first into canola because that's a fun one. Wouldn't you agree?
Absolutely, it was a good day today.
It was a good day today. What did you make of the last couple of days of strength? We saw some strength yesterday that pushed up towards not quite to 700, but into the 690s. Today we closed into the low 690s. How does this feel as a farmer?
Volatile. I think that's probably wraps it up in one good chunk here. We seem to be trading $20 a ton in a day, and I think we're kind of a little bit on that teeter-totter, and we could swing one way or the other. So to see maybe some positive closes at the end of the week can provide maybe just a little layer of comfort here.
Mm-hmm. I did notice that the canola net short position by managed money is now south of 100,000 contracts short. So I think that is a record by quite a long shot. So there is a pretty big long position that was built into the beginning of this week in this market. Do you think that had a role in what happened over the last couple of days?
Oh, absolutely. I think from the big picture here, all eyes are looking forward ahead. We already know what Canada produced, and I don't think it's a big secret that all us farmers are whispering to one another saying, my canola did run a little better than I thought it was. And I think that's maybe not a bullish layer we can add to the equation like we did last year. And so I will say I'm not seeing a whole lot of fundamental changes here. So maybe we're looking for a technical short covering rally, and maybe that'll give us an opportunity to do some pricing.
Mm-hmm. Mm-hmm. You can see this market has kind of struggled to, get above this 20-day moving average. In your mind, where do you think action will get taken on a move higher? Do you think it will be as early as 700 or maybe wait? Do you think that there'll be some participation once we get to 720, or what kind of values do you think would on the futures chart here would you think would generate some interest?
That's a question I loved asking clients in the last week, because I think for the first time in a long time, our market's going to be really susceptible to farmer selling. And I do wonder if that could potentially put a lid on if all of a sudden, with rising interest rates, the cost of farming increasing, the value of money has changed a little, people are going to hit selling harder. And so, 3 weeks ago, I probably had every single one of my clients, or a good chunk of them, all said, if we got $18 canola, I'd love to sell. And I think in the last week, all of a sudden they went, 16's not bad. And it seems how we've had such a real sentiment change. And I'm not sure if they are still firm on that 16, but that's at 16. That'll be just over that, $700. I'm sure we're going to get some basis. We've had some good basis rallies in Alberta over here.
There definitely seems to be still an appetite for, particularly for crush, and I do have some charts on that as well. Um, I'm thinking from my perspective, the 705, the 700 to 705 area kind of brings this rally into a new high territory. Kind of drawing that out here on the chart. But if we can kind of break above that, I think that there might be some room to move. But the scary thing would be if there's farmer selling that comes in at that 700 level that kind of knocks it back down. What kind of what kind of ways about protecting prices have you been? What kind of conversations have you been having out there in the last week or so as the price has been declining?
Um, Looking at a lot of even just like what your cost of production is, I think that's really important. This is the most expensive crop that we've put in to date. Fertilizer prices were just atrocious last year, chemical prices. And I do think we see maybe a little bit of a light at the end of the tunnel for next year. We have seen fertilizer come back. Roundup, I think, is almost half of what it was last year. Your glufosinate also come back. So when we're looking at this year, I do think we need to be very careful about how we make sales and when we make sales, and if they are profitable, especially considering it feels like we're on a teeter-totter here. These are some profitable sales here still. Maybe we do need to consider looking at making sure we lock in some profits, and if the market sentiment changes here, maybe looking at a re-entry strategy down the road. That's kind of some of the thoughts that I have.
Okay. What has been here? I'm going to throw up a chart here of weekly exports. Now we did see the best export number just over 275,000 tons this last week, or the week ending, I guess technically the 29th of October. A good export week. It's probably been the best one all year. What does the sentiment feel like in the elevator system? So if we kind of exclude the crush and from the rest of the system, have the elevators been looking for a lot of canola? What's been the feeling at the elevator as far as canola deliveries go?
I would say no. We've had a huge change in sentiment, and even people who have been maybe loyal hauling to elevators, it's hard to haul to an elevator right now. Is the demand is not the same, and crush plants are offering 30-40 bucks a ton more, and we're not seeing canola move through elevators. So I'm a little bit shocked to maybe see a rise in exports here. But I think they're going to be weaker this year if this crush margin stayed this wide.
Mm-hmm. We definitely are seeing a trend towards that. And yeah, as you can see, most of these weeks through the crop year have been below average and below last year. This was the first week of reporting that it showed, kind of better than both of those. And perhaps that's an anomaly, but that's kind of the way that's kind of the way that the market has been structured, is heavily towards the crush. One interesting thing I did see is that the visible commercial supplies really dropped off this week in the reporting. And what I find interesting about that, I mean, it could be interpreted two different ways, right? It could be a bearish signal that that the market is slowing down, that crush is going to slow down, that exports are going to slow down. Generally we see slowdowns because of weather, but in this case, it might be because of supply. On the bullish side, if you were to want to interpret this chart bullish, it would be that commercial supplies have declined. It's below average, below last year's pace, which would mean that if particularly the crush side of the visible commercial supplies, they may be looking for canola, and farmers aren't necessarily willing to deliver it. Would you say most are kind of sitting on their hands waiting for higher prices now, and that it's difficult to kind of get the bin doors open?
I think a lot are sitting on their hands, and I feel like there's a pile of people waiting on the sidelines for that pop to make that sale. And I do wonder if that farmer selling is gonna be more than traditionally this time of year. And I do think it could put a lid on things for a short term, anyways.
Mm-hmm. Okay. I don't know if you have any questions for me as we run through this data.
I probably will down the road, maybe.
Okay. You know what? I was just going to, as we kind of were preparing for this call, so I'm showing the Copa Weekly Crush here. The new report would have come out kind of as we were were prepping for this. Let me see if I can pull it up here.
One question I had a client ask me this week was, maybe the outlook of the crush market over the next few years. Where are we at on all these, the ones coming online now?
Yeah, I believe the next one to come online is Cargill in Regina, from what I understand. Some of them have kind of been held off, and even the Cargill one, I believe, was delayed. So I think that they're hoping to add that capacity in. I don't know if it'll be harvest of next year, but maybe calendar, closer to the calendar year 2025. Oh, this is interesting. We saw a pretty big drop in crushings this week at 206,000, with a capacity utilization of 88. We've been running, in the 225 area here in the past weeks with a capacity utilization about 94. So it was a pretty slow week in crush, which like this would be coming into last week. So that kind of does explain some of the weakness maybe in some of the futures markets previously.
Weak, but still incredible.
Yeah, it's still kind of tracking. This is a 5-year average, and I mean capacities have risen, but the next week here would probably come in 206, would look somewhere in here, so still above average and still above that 200,000 mark, which is still really good. Year to date, they're still running 94.3% of capacity. So, I in my previous life, it was anything over 90 was spectacular, and we've been running that basically since the start of September here.
Mm-hmm. What would you say if crush could run at this kind of capacity? What is it possible they could crush for tonnage?
I think you'd be looking at about 10.5 million tons.
Okay.
And so that's kind of the bottleneck of the market, is that crush can run. We can do a lot of crush. I'll put up a chart of board crush margin here. We can incentivize as much crush as possible, but there's a limit in how much that can get crushed. And so if, as we were kind of referring to before, if yields are a little bit better and we're adding to the supply, that extra supply, either needs to be exported or it needs to go on to the ending stocks. And if it's not being exported, then putting it onto the ending stocks is a bit of a bearish input, which again, that might explain quite a lot of the reason for the recent declines in canola prices.
Maybe to add to that statement there, do you maybe have some thoughts or ideas of how much could actually be added from the yield adjustment from farmers?
Yeah, well, if you want to use statistics, like generally speaking, Statistics Canada adds about 1.5 million tons of canola from their mid-September assessment to their final assessment, which is generally 2 years later. I would expect some increases in the December, that's what they call their final number, although they continue to adjust it after that. But, we might see, I don't know if it would be as strong as 1 million tons, but it could be getting up into the high 100,000s, like 600,000-700,000. And you know what, I don't really think the market would be surprised by that when we, there's still quite a ways away until that report comes out. But once we start seeing analyst expectations, I think there's going to be an expectation of an increase.
Oh, so you think there's probably a whisper number in the background of that?
Yeah, and it's probably 19 million plus at this point. So I think right now StatsCan dealing with 18.4 or 18.5, if I'm remembering correctly. I think 19.1 would, that's kind of where I would be putting my Statistics Canada guess, and maybe my official guess would be even a couple 100,000 higher than that. But that's probably what we're dealing with. But again, I think this is not a new piece of information today. This has kind of been building over time. So once the StatsCan report comes out, I think it'll largely be built in.
Well, I know StatsCan's been phoning me a lot, and I'm sure this report would be more accurate because I know farmers never lie to the government and StatsCan.
Well, hopefully that you are doing your part and are responding to them, because it's funny. StatsCan's never right, but they're still the best, data with the most reliable history that we have. So it does still it is still important, even if it isn't 100% accurate. One strategy I think that might look attractive here is that as the market has declined, the yield curve has strengthened or has moved to more of a carry market. And what that kind of looks like is, there are futures months that, or as you go down the calendar, the value of the futures months goes higher, right? So there is some carry to capture in this market if you're looking to capture that. Now, you don't have to. Generally speaking, I don't think most of these elevator companies will allow you to lock in a futures like kind of only contract and hold off on the basis. That may be a play for you to consider, particularly if if the crush, if you're selling into the crush, because there's probably some opportunity there for better basis levels as we go forward. But there is a carry in the market, and in order to capture that carry, you do need to sell the carry, because unfortunately, generally speaking, in a carry market, what happens is the market floats down to cash prices instead of rises up to where those carries are. So that's one strategy. Whether you utilize the elevator system to do that, or if you have access to a brokerage where you can do a hedge like that, those are both valid strategies in carry markets like this. I did want to touch, I think, the previous one. This is canola board crush margin. It has come off in the last couple of days, but as we kind of rose through middle of October into the end of October, crush margins strengthened largely because of the drop in the seed values, right? So when the crushers are sourcing seed, they're doing it at more affordable levels, and the other products did not drop as far. In fact, the meal side of the products, as we've been talking about in some of our other reports, has been very strong. So the crush margin increased quite substantially. It kind of got up to those highs seen in September and even in June, where a lot of this fall crush was booked. So we might actually see that carry into January. There might be some good movement opportunities, particularly for kind of December, January, or when that January board crush margin is hedged. And this is the most profitable board crush margin on the calendar, meaning, as you move forward, if you look at the March or the May or the July, the crush margins are actually lower. So there is an incentive for crushers to book that margin and book up their capacity into the crush plants for those, for the months that would satisfy the January contract. So there could be some demand coming.
Another strategy I've talked about with producers is to really just have a look at what you're paying for interest costs. And I know that seems like such a kind of a silly statement, but sometimes when you sit down and you really look at what you're paying per month for interest, and maybe what your goal is to sell grain, at time, if it takes time to get to that value, I've had a few people come back to me and be shocked that I didn't realize I was paying that much in interest. And that's another strategy to make sure you're looking on the farm is, before we were paying, 3% on an operating loan, and now we're maybe that 8%. If you're running it at a retail, it's probably 10 to 12%. It's a very different world we're living in than just 3 years ago.
Mm-hmm. Mm-hmm. That's very true. And, it could suck up all, these carry charges that I was talking about earlier. It could suck up, a lot of that. So there may actually be an advantage to selling on the more forward months, on the more nearby months, and, and paying down LOCs or operating lines, things like that carry a high interest rate, or are basically sucking money value out of your account just by having it.
Yeah.
So yeah, very good point.
Another thing on the flip side too, which if you look at, could you enter into, maybe if you don't need the cash, could you enter into a GIC or something? Could you do something with that money once you have the cash in the bank? Like, that's another thought too.
Mm-hmm. Yeah, it's almost, paying down debt, or even some of those fixed income, that's guaranteed money, where speculating on commodity prices is, as we know, extremely risky.
Yep.
Some other good green shoots, here's Euronext rapeseed. It kind of popped up. This gap here is largely the rollover between contracts here, but But this pop here today kind of moved it above some moving averages and closer to some of these previous highs. So it's not just canola that we're seeing some strength in. We also have some of the outside markets participating as well. So it's giving a little bit of hope. I think there could be a chance here for a bit of a counter trend rally. I thought I'd touch on soybeans, and I know, particularly for yourself in your area, Janelle, there isn't a lot of soybeans grown, if any at all. But I do think it's important, A, for our Manitoba customers who do have soybeans, and B, just the correlation that happens between soybeans and canola. Although that seems to be disconnected right now, but there is a possibility that it will become reconnected. We did see soybeans have a really great day today. Trade and close up above 1350, above all these moving averages. This looks like a really, really healthy market now. We could see, a test of this previous kind of resistance at 1380, and then as we kind of move up here towards 1420. So I would say the wind is in the sails here now in soybeans, and in the weekly report that may actually be in your inbox as we speak. We kind of changed our outlook on the bean market here from a more neutral stance to more of a bullish stance. So we could see a bit of a short-term run or short to medium-term run here in soybeans as well.
What do you think was probably the big driver that was able to push through that resistance?
It's funny you ask, because my next chart is this is the December soy meal, and we've been talking about that for quite a number of a couple of weeks now as this rally happened. The old saying is a meal rally is a real rally, and this soybean meal rally, which was predicated on low supplies of beans coming into the crushers in Argentina, creating kind of a shortage as there's that gap between the South American crop and the U.S. crop hitting the market. Generally speaking, there's enough in Argentina to continue crushing until the U.S. beans hit the market, which is generally in late December and into January. But that has really shortened up, not only because of their crop failure last year, or at least their decreased size and crop, but also the inflation pressure that they've seen over the last couple of months has just kept the beans in the bin, because you don't want to sell your beans, turn it into cash, and then have your cash devalue at a very rapid pace. Even like day to day, it devalues there in Argentina. It's a bit of a currency financial crisis happening there. So the meal rally is real. It really took, it looked like it was backing off, but as we traded into the end of this week, it kind of punched up back towards almost right in line with where it closed on that day. It made that new high back. That must have been late last week there. So yeah, the meal is really pushing this thing higher. And also weather in South America is not perfect. It is improving to some degree, but still some risks as we kind of get into the end of seeding down there and seeing how many delays there are in some areas. Juxtaposing that, this is soybean oil. And so again, actually canola has moved today, took a bit of a soybean oil. We saw soybean oil sink to new lows today and close at the lowest it has for quite some time, since spring. So this market continues to look weak, and some of that is correlated to the meal, because if there's meal being hedged on the board, you got to sell the soybean oil as well. And if there's nobody to stand there and buy it, then it tends to get pressured lower.
Do you have any insight on like what the different oils, like why someone might prefer the canola oil versus the soybean oil?
Yeah, right now, canola oil is largely used for canola oil produced in Canada. I would say Canada, Australia, that's exported to China. A lot of that is used for food grade, right? So our largest buyer of canola oil is the U.S., and it's largely sent there for food. In Europe, it's actually a bit of a different story. It's largely used for biofuels, and the market is shifting more and more towards biofuels. In fact, there's some speculation that some of the capacity expansion in Canada that's happening with canola is meant specifically for the biofuels industry, maybe even the aviation biofuels industry. So there is definitely more demand coming from that sector, but it's still primarily food use at this point. Soybean oil is used a lot for biofuels. There's more capacity coming online in the U.S. to process soybean oil as well, particularly for sustainable diesel and things like that. So the biofuels sector is probably the largest growing at this point. And it's what's creating the growth story behind some of these vegetable oils. Right now, however, like the largest importer of vegetable oils is India, and they have a very large supply. They were kind of building up their supplies in fear of rising prices as the inflation story was had the grips on the market, as well as the food scarcity concerns that happened over COVID. So everybody's just kind of being cautious. So they built up a lot of reserves, and then as we're just kind of moving out of the high production time frame, the seasonal high production for palm oil, there just has been a lot of supplies of vegetable oils as a whole on the market in the last little while. So some of this may just some of this weakness in oil may be seasonal.
Do you think canola and soybean oil could split apart from one another, or do you think they're probably going to remain tightly linked to one another?
Obviously, today's an indication that it is possible to decouple. Crush margins for even with crush margins for canola are hedged off of soybean oil, and even with that, margins are still really healthy. So I think that continues. That's really what matters most, right? Is like, how much can I crush? And it doesn't even matter if it's in Canada. How much can I crush and make money in Canada? If we export it to China, how much can they crush and make money? It's all about the crush and the margin that the crush produces. I'm not sure about the Chinese crush margin. I know that it's often squeezed to zero or even below zero. I don't know what that number is right now off the top of my head, but in Canada particularly, it is very healthy. And soybean oil or soybean crush is very healthy in the U.S. as well, but that has a lot to do with the meal, whereas our canola crush doesn't have as much to do with the meal. The share of the crush, this chart, this really took a hit today too. This is oil share of crush margin. This is for soybeans. This just is a percentage. So 36% of the value of the crush is derived from oil. That's what this means. So the rally in meal and the decline in oil is what's creating this. So, earlier there was a significantly higher value placed on the oil of the bean crush, up to 40, into the mid 40s area. So a bit of pressure coming in on this oil share from the declines in prices as well.
So moving forward here, and this is, you probably love when I ask this question, what would have to happen in this market, in this market sentiment we're in, that you'd actually get you excited about canola?
I'm quite excited from a contrarian standpoint. I'm excited about the short position in canola. I think that any catalyst in the vegetable oil market will create an exodus of traders in that market. I think it's too large, and I think it needs to get peeled back. Not that I recognize that traders may want to remain short as a net in that market to capture. There is like spreading that happens in a carry market, and where you want to remain short. That's why Chicago wheat is often sold short for long periods of time in order to capture carry. Canola can do that too, but I think the size of that market is outsized, or the size of that position is outsized right now, and I think it needs to get right sized to something a little bit more comfortable, and I think that could cause a bit of a canola rally. We're also moving into the time of year where we often see terrible weather, and that means that trucks have a hard time loading, augers don't start, it's harder to move around rail cars. That produces sometimes a bit of a supply crunch, and that's why we sometimes see some seasonal strength as we move into the winter months, because those crush plants aren't designed to store a lot. A couple of days worth, maybe up to a full business week, 5 days in some cases, if you're not crushing at 90+% of capacity. But they need to keep replenishing the stocks in there. It's kind of a demand pull market where it's most efficient when there's trucks arriving every day and replenishing what gets crushed. So any hiccups in weather on the Canadian prairies could have an effect on that, and it could help create a bit of a short covering rally in that market.
And that'd probably be a bigger impact moving forward if more canola leans harder into the crush market versus elevators.
Exactly. Yeah. Yeah. I mean, we should be the other flip side, and I haven't seen any evidence of this yet, but the decline in seed prices and the rise in board crush margin should incentivize some exports as well. So everything is based on price and on when prices can get to a value that makes sense to do something with it. So we're obviously not in a shortage situation in canola this year like we have been in other years. So the margin with which to process is probably going to be the major driver of the market this year. In those short years, the margin gets squeezed, right? So there's less money to be made because there's so little of it around, and buyers have to pay up for it. In markets like this, the margins are healthy, which incentivizes, can incentivize some demand because you want to turn wheels and make some money on it.
And so when you say incentivize demand, do you mean more like of a basis rally?
That may be part of it. If futures don't behave, then yeah, you'll see a basis rally. But generally speaking, you see basis and futures move together to some degree. I don't think you'd see a wide difference, but I don't think you're going to see a massive basis rally in canola and while the futures are falling. I think they'll both participate to try to incentivize some sales. But as you were mentioning earlier, I think the wet blanket on the market might be some farmer selling, at least early on, right? And that may dissipate as we move towards the springtime. But we may be. I don't think this market is going to V bottom, if you know what I mean. Like I don't think it's going to test a low and then come screaming back higher. I think it'll be a grind, and we may have to hit the smaller rallies when they come, and then utilize risk management strategies, OTC or over the counter contracts, or even brokerage for those who have access to it to access higher prices when it happens in spring.
That's fair.
I don't have to touch on corn much, except corn also participated in the rally. Today, it as you can see on this chart, it bounced really nicely off of that support. I think that's 467 support. Really nice test of that and a rebound. Interestingly, corn struggled to stay above $5. It was only up above there for a couple of days and then failed. And I think it failed more spectacularly than most were expecting. So, this market may be still in for a bit of a sideways trading range. Not that it has a huge impact on many Western Canadian farmers, but there are some correlations to wheat and just general market sentiment as a whole. I think our bias on corn is still over time still to be bearish. The supply of corn is really quite comfortable, particularly in the U.S. There are some issues occurring in South America which may change, but at this point, I wouldn't be willing to put any hard-earned money on it.
I'm actually seeing in my local area there's actually corn being railed in here and then hauled to the ethanol plant here. So we are seeing like corn literally in our own backyard here, and kind of in some of the discussions that I've had is it sounds like, in the drought in 21, that was probably the really big year they started bringing corn in, and all of a sudden, once they've done it once, they got scared once, had to do it, they got a lot more comfortable, and it seems like that corn is a lot easier to bring in than it was even 2 years ago. And they're less scared of it. And it's showing up in our backyard more often than what it would have 5-10 years ago.
Yeah, exactly. And so if we can if the price drop incentivizes demand, that's a good thing. That's how you get some support built into the market and some floors get put in. So if we do start to see that buyers are finding value in current levels, then that would be a bonus. There are some outside factors that might affect that, right? The price of oil. Actually, I think I have a chart somewhere here. Yeah, oil's kind of been declining. Oil's been really interesting because after the October 7th terrorist attack in Israel, prices moved higher above $90 and then have just sunk back to pre-October 7th lows now. So the oil market is struggling, and that I think will have an impact on ethanol, which in turn would have an impact on ethanol margins and so on and so forth. But it doesn't look dire yet at this point, but it is interesting how weak crude oil has been in the face of a Middle East conflict that looks like it might accelerate.
Do you think that could be a little bit of a seasonal thing? That, harvest is wrapping up in North America. Do you think that has any impact on that?
I don't know how much, how much weight the farm community has on the crude oil price as a whole, but there could be, yeah. Generally speaking, there is a seasonal aspect to the summer months are seen as higher consumption, mostly actually because of the the amount of travel people do in the summertime in the northern hemisphere.
Okay.
But yeah, it is an interesting, crude oil is an interesting one, and it might be responding to some economic information as far as there's a number of factors that look towards recession in some economies, including our own here in Canada.
Yeah.
The one thing, and I self-admit I do not make a recommendation for this very often, but the one thing, and I think I have a chart in the weekly report this week about basis levels for hard red spring wheat, which have really accelerated recently. Part of that is because the Canadian dollar has been falling, and that always helps basis levels. But part of that might also be low farmer selling. Although the statistics, I don't think I included them in here, but the statistics similar to the canola statistics on delivery, like farmer deliveries of wheat have been pretty healthy, above 400,000 tons a week. And so I don't necessarily think it's a big lack of farmer selling, but the other thing is just the FOB prices have been rising for Canadian, 13.5 wheat, and that means that some of that has been getting pushed back onto the farmer basis. And I actually think it might be a good time to not necessarily lock in cash prices on wheat, because I think, as you can see, the futures here are have kind of tried to double bottom here with this bottom in late September and now this one in Nov. I feel like wheat is going to come out of this trough at some point, but so I don't necessarily think it's a good time to sell futures, but I think it's time to have a discussion about separating basis and futures, and the basis piece of the pricing puzzle might be an interesting one to look at.
So if a farmer does get into a contract like that, what do you think the exit strategy looks like? Where's maybe a general target where a person can get into? Like I think most basis are running off of December futures, which is only getting you 2 weeks of time here. You probably got to pay 20 cents to roll into the next month. Like, what's kind of the thoughts about where a person might exit that?
Yeah, that's and a break of these support levels around $7 would probably be the as far as exiting on the downside. I guess we'll start there. If it starts to break down below these previous lows, that would give you an indication that, okay, there's more weakness in this market. I don't want to have you don't want to be holding a basis contract in a declining market, and that would probably be the exit strategy there. Now, the problem I find, and this is why I don't recommend basis contracts very often, is that they lack a discipline mechanism. There's no mechanism for discipline, And the path of easiest resistance, or the path of least resistance, is to sit and do nothing. And so many times I've seen basis contracts just fade, the futures fade down, and they watch the value of their contract decrease, and then as you get to the forced roll time, so like, the end of November or whenever the forced roll is, then they end up paying the carry, they take a hit on the basis, and then they roll to the next month, and then they just watch the market do the same thing in the March or the May. So I think you really have to have strong, if you're going to engage in a basis contract, you have to have strong discipline to get out when the market makes a new low. And right now, I think that's somewhere around the $7 mark on Minneapolis December. One way to get around that is to use minimum price or floor price strategies, or there's a number of different companies that offer kind of these floor pricing strategies. And the good thing is instead of paying the carry, to roll the contract, you can just take that money and say, okay, instead of paying a carry, I'm just going to and having the same amount of risk, invest it in a minimum price contract. Take that 20 cents or whatever and say, okay, I'm just going to, instead of doing a minimum price off the December, I'm going to take that extra 20 cents and I'm going to invest it in a minimum price contract on the March or on the May or something like that. And I think you might get better results that provide, less risk, obviously, because your floor price is set, and then less, fear of missing out or regret if the market does take a run, because you're still in the market. Mm-hmm. So I really do like minimum pricing strategies in this market. It does allow you to take advantage of the basis gains that we've seen.
One
and
thing,
what?
Oh, go ahead.
Yeah, I'll just add one more thing too. It's like if the basis the basis may continue to get better. That's the other thing, is that, and so I wouldn't necessarily look at it as, if you make a basis decision and the basis continues to go higher, I would try to fight that urge to regret your decision, because I would look at it as a stepped approach. And if it continues to go higher, continue to make those, if the basis continues to get higher, continue to make those decisions, like sell into the strength of basis, and don't try to pick the top with one big sale. I would, advocate for doing it in tranches.
One thing I have also asked clients in the past while is what's the farmer selling point for wheat? Same thing for canola. Like, is it possible farmers do hit some of these sales harder than expected? And I mean, I'm not saying that will or won't happen, but I do think it's something to be paying attention to as well. Central Alberta, we're seeing a lot of these $10 wheat specials, and it seems that's a place that farmers seem comfortable selling at.
Yeah, I would say, my feeling is that the risk is a little bit lower than it is in canola, and simply because those targets have been there already. So, the first round of folks who wanted to sell at $10 probably did. And then, there's always kind of that like contingent of folks who will, say, well, if it gets back there, I'll sell again. And then they do. And so, but eventually, if it keeps doing that, right, then you kind of exhaust the sellers, and then there's an opportunity to rise. Consider, if the market is still kind of in this neutral territory. So at some point, everybody who did want to sell for $10 is going to have sold for $10, and they'll be waiting for the next leg higher. So if you do see those opportunities present, I would take them. But the problem is that, as a broad approach, obviously the western part of Alberta probably has the best prices and gets to that $10 area first. If you're a farmer in central Saskatchewan, those prices look lower, and you may be thinking, well, I want the $10 and I'll wait, but you kind of have to back off the freight difference. So it might look more like $9.50 or $9.75 to you instead of the $10 area.
So I'll ask you the same question I asked on canola. What, from a farmer perspective, what would you have to look at this chart and this market for you to get excited about something in wheat?
I think a move above 750 would get me excited. In actually, these red lines, the reason I put these red lines on the chart is these are kind of the support and resistance levels. So somewhere between 750 and 760, there's some support. in any trade inside of this range, I would call it noise, right? It's not really giving us directional bias. But once you start making new highs, if it starts breaking above this 760 area, that would give me some. That would get me excited. That would give me some confidence. And then if we start to break above this 790 back into $8, it would get me excited as well. There is lots of risk in this market. I mean, the Kansas contract, which I think I have on the previous, there was support building, through October at some levels around, 670, and then it broke down. This market continues to look weak. It keeps testing the 20-day moving average as it moves here and keeps failing. That is a concern that could happen in Minneapolis as well. So yeah, a move to a new low on the downside would get me excited on Minneapolis as well. And that might be where, if instead of just using a basis contract, if it starts making new lows, you might want to just do a cash contract. But I would, the market does have the ability to give us head fakes. So I would always have a plan B on what you are going to do if the market, decides to turn around. And maybe, maybe that's nothing. Maybe you're content with your unsold, everybody's going to have an unsold position that's going to have exposure to upside. And if you're okay with your unsold position, that's great. But if you feel like you're going to have some FOMO or some fear of missing out, then I would encourage you to have a plan B and know that plan B before the market gets exciting.
Mm-hmm. It's hard to figure out how to manage regret in these last 2-3 years with grain sales. It's just so volatile. Yeah.
And, one of my favorite contracts has always been minimum price style contracts because it kind of gives you your cake and you can eat it too. In the last couple of years, the cost of those, particularly because of the conflict in Ukraine and Russia, the cost of protection or upside participation was really high. It's really come down in the last little while. So there's definitely some incentive to utilize those contracts without a whole lot of risk now. That's about all I had. I think there is some currency risk. Like one of the reasons I was talking about basis was, we've seen 2 days of a really strong Canadian dollar rally. That is, also been on the same thing as the US dollar weakness. So, there is an opportunity that the Canadian dollar is going to rally and suck some of the value out of the Canadian wheat basis. The crude oil price I was mentioning earlier, if it continues to fade, that's going to have an effect on the Canadian dollar as well. So there's lots of, there's lots of risk factors. And I do feel like our official position at FBN, I'm feeling a little undersold. So I do want to, find a place to get up to a place where I'd feel more comfortable. But I do think that some patience will pay off in this market because I still think we're in the throes of some seasonal weakness.
She's been a ride.
You bet. All right. Well, we're probably getting close to the end of people's tolerance for you and I talking on a Friday afternoon.
They probably hit that tolerance a long time ago.
All right. Well, thank you for joining me, Janelle.
Thanks, Brian.
Have a great weekend, and everybody have a great weekend.